In this video, I'm going to show you something counterintuitive about how you draw down your 3 investment accounts, and getting it right could save you a lot in taxes. Coming up next on Holy Schmidt.
Holy Schmidt!
If you own a Roth account and you're optimizing for taxes, and most people who own a Roth account are, then you probably have 3 different types of accounts. And those 3 different accounts are taxed differently from one another. And once you see this clearly, the right order almost picks itself. The first is your taxable account. This is a regular brokerage account or mutual fund account. You already pay tax as you go on dividends, interest, and gains you realize. There's no penalty for using this money at any age. The second bucket is your tax-deferred bucket. This is your IRA or 401k. You took a tax deduction when you put it in, so everything you take out of this account, you pay taxes on, or at least it's considered ordinary income. The third account is a Roth IRA or Roth 401k. You contributed after-tax dollars to this account, and as long as you're over 59 and a half and the account's been open for 5 years or longer, you can take the money out without paying taxes on it. So picture the 3. Your brokerage account is at least partially taxed in most cases. Your traditional account is untaxed, and so you pay full taxes on that. And then your Roth is tax-free. Choosing which bucket to draw first is really a choice about when to pay your tax bill and how big it is. Here's a quick way to feel the difference. A $1,000 withdrawal isn't always $1,000 in your pocket. With the Roth, you take out $1,000 and you get $1,000. From the traditional account, you get only what's left over after taxes. And from the brokerage account, you owe little taxes because you paid taxes along the way and you contributed to that account with after-tax dollars. And from the taxable brokerage account, you often only owe a little because part of the money that you receive is just the money that you've contributed to the account, and you already pay taxes on that. Now, here's the order that most planners start with. Spend your taxable money first, your tax-deferred money second, and leave your Roth for last. There's clear logic in it because spending your taxable account first means that your tax-deferred IRA or 401k can continue to grow. This keeps the tax deferral intact, and leaving the Roth alone lets your tax-free money compound the longest, which is the money you would most want late in retirement or to leave behind. There's a second reason to lead with the taxable brokerage account. Long-term capital gains are taxed at capital gains rates, and that can be lower than the retiree's ordinary income rate, and sometimes as low as 0. So spending that money is often cheaper than it looks. And if you retire before age 59 and a half, then this order matters even more. Pulling from a traditional IRA or 401k can trigger a 10% penalty rate on top of the income tax that you'd have to pay. The taxable account has no such penalty, so it's the natural place to start. But this is a starting point. It's not a rule to follow with your eyes closed. Let me explain. The order assumes that your income is steady and your tax brackets won't jump around a lot in the next 15 years. But for most retirees, that's just not the case. There are 2 things that break this simple rule of thumb. The first is when the retiree draws Social Security, which is somewhere between age 62 and 70. And the second is required minimum distributions, which happen for a lot of people watching this video anyway at age 73. And for those of you who don't know what required minimum distributions are, that's when the government forces you at a certain age to sell part of the holdings in your 401k or your IRA and realize the taxes on those amounts that are withdrawn. And it's the second one, by the way, where the real money is won or lost. Now, there is a common misstep, and that misstep is to spend the Roth first. And why do people do it? Because it's tax-free today, and people feel good when they take money out of their account tax-free, not realizing that that money has a better use at a point later. Your Roth accounts have no required withdrawals during your lifetime. Your traditional accounts do. If you drain the Roth early and let the traditional IRA and 401k keep growing, those balances get bigger and bigger, and so does the withdrawal the IRS will eventually require from them. Picture 2 retirees, both with $500,000 in a traditional IRA and $500,000 in a Roth IRA, both age 65. The one who spends the Roth first lets the traditional side keep growing, perhaps up to or exceeding $700,000 by age 73. The one who blends the withdrawals keeps the traditional side smaller. Now, what happens at age 73? The first retiree faces a much larger withdrawal at age 73 in every year for the rest of his or her life. A bigger withdrawal means more taxable income every single year. That can mean a higher bracket It can mean that more of your Social Security is taxed, and it also can mean that your Medicare Part B premium has an IRMAA surcharge. I'll connect all of the dots on that in just a minute. Spending the Roth first trades a small manageable tax bill into something much worse, potentially anyway, at a point in the future. The tax-free bucket is valuable precisely because there is no required withdrawal from it. You can time it at a point that works best for you. Speaking of IRMAA surcharges in Medicare, gang, Medicare can be confusing. It can be overwhelming. Ask anybody who's age 65 or older, and they will tell you that this is true. They'll spend hours of time analyzing all the different plans. They'll pick the plan, and they'll realize they made the wrong choice, costing them hundreds, if not thousands of dollars a year. Now, on this channel, we have 3 affiliate relationships. One is our trusted Medicare partner, Chapter. Chapter is the only national advisor that looks at and recommends every plan. They're totally free to you. They save their clients an average of $1,100 per year, and they're really easy to work with. The best part is that it takes about 20 minutes of your time. If this is of interest to you, give them a call at 440-703-1224 to see if they can help. Now, the good thing about required minimum distributions is that they're formulaic. You know what amount you have to take out, and you know when you have to take it out. For most of you watching this video, it's age 73. If you were born in 1960 or later, it's age 75. But that's the point where RMDs start to impact your life. And the formula is simply your year-end balance divided by a life expectancy formula provided by the IRS. Here's a rough, very rough sense of scale. Let's say you're age 73. At 73, the IRS life expectancy factor is about 26.5. A $1 million traditional balance produces a required withdrawal of $37,700 in that first year. A $1.5 million balance produces about $56,600, all taxed as ordinary income, stacked on top of any Social Security and pension if you're lucky enough to have one. Now, let's say you forgot that there's a required minimum distribution and you just skipped it. Well, the penalty is steep. It's 25% of the amount that you should have taken out, dropping to 10% if you fix it within the first 2 years. So you can't really not take out your required minimum distributions. They're required. So if you spend your Roth first, that balance will grow and grow, which is a good thing, but it's not. Now here's your lever. Fill your low brackets in the gap years. The years between when you retire and when RMDs begin are your planning window. Used well, they can lower your tax bill for the rest of your life. In 2026, after the standard deduction, the next $24,800 is taxed at 10%. And then it stays in the 12% bracket until income reaches $100,800. Now, how much is the standard deduction? Well, right now, it's generous. $32,200 for the couple, plus an extra $1,650 for each spouse who is 65 or older, plus a temporary $6,000 deduction per qualified person. That runs through 2028. You stack those all together, and that shelters a lot of income before you even hit that first bracket. So what do you do then? During your gap years, you deliberately pull from or convert your traditional accounts up to the top of the 12% bracket. One recent example I read on Yahoo Finance showed a retiree with $1.4 million was able to stay in the 12% tax bracket using this strategy for the rest of their life. A Roth conversion is the same idea, but with a bit of a twist. The same person withdraws those funds and puts them into a Roth IRA. They're still in the 12% bracket, but now they're populating their Roth. From then on, it grows tax-free and carries no future required withdrawal. So if you put numbers on it, a 65-plus couple's deductions can shelter about $47,500 of income. The 12% bracket then runs up to $100,800 of taxable income. So a couple can bring in well over $100,000 of income and still stay in the 12% bracket. So this is the opposite of how our mind usually works, and that is avoid all taxes if possible now. You're not dodging the tax. You're just choosing which year to pay the tax and capitalizing on the fact that over time, that window typically has a lower tax rate for a lot of people. Importantly, run your own numbers before you do this. The right amount depends on your balances, your income, and when you claim Social Security. This is exactly the kind of question that a good modeling tool or a session with your tax preparer pays for itself. Gang, how prepared are you for retirement really? Most people think they're more prepared than they really are. Because of this, I've put together the Retirement Readiness Quiz. It's 15 questions, it takes 2 minutes, and at the end, you get a 12-page report sent to you instantly. Totally free. No credit card, no phone number, nothing like that. If this is of interest to you, go to holyschmidt.com/quiz, take the quiz, and get your free report. You'll also be added to our list and get tips, tricks, and other information a few times a week. Now, income tax is only part of the story. There are 2 other costs that could go up if you don't optimize this. The first is how much of your Social Security actually gets taxed. The IRS uses what's called a combined income formula. That's your adjusted gross income plus 1/2 of your Social Security payment plus any tax-free income you receive. You put all those together, and that number will determine how much of your Social Security gets taxed. Let me explain. For a married couple, once combined income exceeds $44,000, up to 85% of Social Security becomes taxable. That doesn't mean that you pay 85% tax on your Social Security. People think that. That's not the case. It just means that 85% of your Social Security payment, up to 85% of your Social Security payment, can become taxable. A large withdrawal from a traditional IRA or 401k can be just the thing to push you over that line. One recent analysis shows that a couple with $900,000 in an IRA can push their Social Security into the 85% taxable bracket once required minimum distributions kick in. Smaller planned withdrawals in the earlier years can reduce that significantly. The second is a surcharge on your Medicare premium, your Part B and Part D premium. It's called IRMAA. In 2026, the surcharge starts at $109,000 of modified adjusted gross income for someone who's single and $218,000 if they're married filing jointly. To put dollars on this, let's look at the Medicare Part B premium. In 2026, that's $202.90 a month. If you exceed those thresholds by even $1, then you have to pay an additional $81.20 a month on top of the $202.90 for your Medicare Part B premium. And here's the part that trips a lot of people up, frankly. IRMAA doesn't use the numbers from this year. It doesn't use your modified adjusted gross income from this year or even last year. It's from 2 years ago. Your 2024 modified adjusted gross income sets your 2026 payment. Your 2026 modified adjusted gross income sets your 2028 payment. You get the point. So one oversized withdrawal or one Roth conversion done carelessly can increase the amount that you have to pay Medicare. When you put it all together, a single rushed withdrawal without doing the right analysis can hit you 3 ways. More income tax, higher tax on your Social Security, and a Medicare surcharge 2 years down the road. This is why the order, size, and timing really matter. It's not about avoiding taxes, it's understanding what the interplay is between the amount you're taking out and those 3 elements we just talked about. Now, are there any exceptions to when to break the order? Yes, there are. If you're charitably inclined and you're over 70 and a half, you can send up to $111,000 from your IRA directly to the charity. That's $111,000 per person, by the way, in your household. This qualified charitable distribution counts towards your required minimum distribution. Your QCD counts towards your RMD. The best part is if you do it right, it doesn't increase the amount of your Social Security that can be taxed. It also doesn't increase your IRMAA surcharge. Think about the survivor years too. When one spouse passes, the survivor usually files as single with more narrow brackets and lower IRMAA thresholds. The same income is taxed harder. So withdrawing funds when you're married filing jointly instead of single can have a positive effect on taxes. The Roth last idea has an additional payoff, and that is if you leave it to your heirs, they don't pay taxes on the growth. Now, they generally have 10 years to empty the account, but they won't pay taxes on the funds coming out of that account. For many families, that means that the Roth is the best account to leave untouched. And if you're under 59 and a half, then you'd lean on your taxable account first, usually anyway, and look for the exceptions that allow you to withdraw from your 401k without paying a penalty. And by the way, none of these are etched in stone. There are exceptions to all of them. It depends on your specific situation, and you do need to understand your specific situation in order to make the best choice for you. If you like this video, check out that video. Most retirees don't know that this Roth conversion window closes in 2028. Also, don't forget to talk to our partner chapter if you have questions about Medicare, 440-703-1224. This is Jeff Schmidt, and I will see you in that video right there.